Greetings. I'm Caroline Gage, Executive Editor for Global Finance at Bloomberg News, and I'm delighted to introduce our distinguished panelists for a discussion on the wealth management industry and the climate in investing. We have Penny Pennington, the managing partner of Edward Jones. She's responsible for the firm's strategic direction, working with more than 49,000 associates across North America. She was recently named number 33 on the Fortune Most Powerful Women in Business list. Jason Chandler is the head of UBS's wealth management business in the U.S., overseeing more than 6,000 financial advisors and $1 trillion of client assets. Catherine Keating is the CEO of BNY Wealth Management and a member of BNY Mellon's Executive Committee. She also serves as the president and a board member of BNY Mellon, the company's national bank subsidiary. BNY Mellon Wealth Management is also a sponsor of today's event. So I wanted to start our discussion with the stock market. Penny, stocks keep reaching new highs. Is now a good time to keep putting money into the market?
Well, Carolyn, it's great to be here with you and your other guests. It's a reasonable question, right? When the headlines show us reaching new highs in different parts of the market every few days. Any good financial advisor is going to tell your guests that they should not invest via headline. However, the stock market is doing well because economic growth right now is very good. We reached the lowest of the lows at the beginning of the pandemic, and so many companies have innovated very effectively, have navigated the pandemic, have served us as consumers in really effective ways. There's a lot of liquidity in the market. Interest rates are very, very low. And so depending on your own appetite for risk, your objectives, we're long-term in our orientation. And so we're going to say you need to be continuously investing and adding to your portfolio. But there are going to be parts of the market that are going to be more attractive, less expensive, with more room to run than other parts. We do expect, though, that there's going to be some volatility. We're going to see great growth rates over this quarter and the coming couple, but then you've got a base effect that's going to come into play, and next year might not look so sanguine, and so we're going to see some volatility. So don't invest via the headlines.
Got it. Jason, can you tell us a bit about your outlook for the economy and what that bodes for the market?
Well, thank you, Caroline. It's a pleasure to be with you and also with Catherine and Penny. I would say following the Fed meeting on April 28th, it certainly painted a brighter picture for the U.S. economy. Simply said, we saw vaccinations going up and we saw infections going down. So that bodes well for the economy. From a research point of view, similar to what we said before, we see lower rates for longer. So clients looking and searching for yield. We also see clients looking for reflation, this fiscal stimulus, reflating the economy, not necessarily leading to inflation. And we see opportunities to invest in the developing markets in the world, really with an eye towards China. So I would say that's where we see the economy and the markets. What we're seeing our wealthier clients do is allocating even more assets to alternative investments, including private equity. And I think all of us would say it's a good time to be in this business. Advice is at a premium, and that financial advisor-client relationship, an important one.
So if clients are reaching for yield, I mean, is that the kind of environment where you want to be chasing that and putting more money in, or how are you suggesting people navigate that kind of a world?
Well, I would say what's working within our firm right now with our clients is our structured products business. So being able to express an opinion, on the market with some safety on the bottom side as well as to the top. And so structured products allow for that individual view on the market where you can get yield without really stretching too much for risk.
Got it. Catherine, was hoping to get your view as well on the economy and in particular on inflation. I mean, you've got an economy that's rebounded faster than anyone really thought a year ago, and now more and more talk about the risk of inflation. I mean, how big of a concern should this be for investors?
Thanks, Caroline. It's great to be here. And inflation is always a concern for investors because if you think about the business cycle and what often ends a business cycle, it's an increase in inflation, which causes the Federal Reserve to increase interest rates, which can, in extraordinary circumstances, lead to a recession and a bear market. So investors always need to be concerned about inflation. And the way we think about inflation right now is we see a bit of a tug of war. We see in the short term some very inflationary factors, right? Things that we've already been talking about, an economy reopening with significant pent-up demand, over $6 trillion in fiscal stimulus, a household savings rate that has tripled with $3 trillion now sitting in household deposit accounts. You see markets tipping at all-time highs. You see household real estate, the value of homes, which is often a consumer's biggest asset, tipping at all-time highs. And so these things tend to be inflationary. And in fact, we're seeing some of the inflation come through as expected. We're seeing it in the consumer price index. We're seeing it in the manufacturing indexes. And the real question, as Chairman Powell has said, is it transitory? And right now, we're continuing to expect it to be transitory because we do see some longer-term factors in that tug of war, which could be deflationary. And those things are things like demographics. All of the major economies in the world are aging. The U.S., Europe, China, Japan, and this country, the average age was 28 in 1970. Now it's soon to be 40. And there's nothing wrong with that, but it tends to be deflationary as economies age. Another thing that tends to be deflationary is large amounts of debt. We've seen debt grow in this country, both public debt, corporate debt, private debt, but the cost of that debt is very low to service. In fact, lower even than it was, maybe a decade ago because of low interest rates. But if interest rates rise and the cost of debt becomes higher, that can be deflationary as well. So, and the last one would be just sort of the technological disruption that we've seen certainly during the pandemic, but really for the last decade. That can be deflationary as well. So we sort of see this tug of war between short-term factors that are clearly going to produce inflation, but some longer-term factors that'll probably lead to a bit of a deflationary environment as well.
So just earlier today, Janet Yellen was saying rates may need to go up if we, do keep seeing prices rising. I mean, what is your outlook, Catherine, for interest rates over the next, say, year or so?
Well, as Penny said, interest rates are at extraordinarily low levels, really the lowest of our professional careers that we're seeing. And so we do think that you will see a rise in interest rates at some point. And we think that we can handle a 10-year Treasury rate, which is, 160 basis points today, that'll go up above 2 and into the 2s and maybe even approaching 3. And we think the economy can handle that as long as it's growing and producing growth.
Got it. Speaking of rising prices, rising asset prices, I did want to, bring up the subject of Bitcoin. We've seen digital assets continue to become more mainstream, and BNY was actually, reasonably early for, the financial space to get into this patch. Catherine, what is your perspective, on this asset class, and what interest are you seeing from your clients?
Yeah, so we have a tremendous amount of interest in this, and you've probably seen it from some of our announcements. And the way we think about it, we start with the technology that's behind digital assets, blockchain, and the potential for that to really change the way we do financial transactions, make things completely paperless, completely automated. We have things that are paperless and to a certain extent automated, but this could really change it. And we see it in really four areas. The first one, obviously, cryptocurrency. Bitcoin, which now has a market value of over $1 trillion, 2 to 3 times what our largest banks are, right, in market value. So it's had a tremendous run. We see it in other digital currencies, right? All the central banks around the world are thinking about digitizing currencies, and you actually have a pilot going on in that space in China right now. We think about it with other financial assets, stocks, bonds, mutual funds, ETFs, and finally, even illiquid assets, real estate and art. So we see this as a financial infrastructure play, and we're quite focused on it as a firm that sits in financial infrastructure as a major custodian. So you've seen us announce the formation of a digital assets group. You've seen us announce that we're working on a pilot for custody. You've seen us announce that we're also working on a pilot for an investment, serving an investment vehicle, an ETF. And for our clients, what we say to them is, we really think about three things when we think about cryptocurrencies right now. One is security. Right? We all know that if you lose your private key, you lose your coins, right? So we think about the security. We think about volatility. Bitcoin has had 80% declines over the last 10 years. That's quite extraordinary. It's again reaching highs, but it's been a very volatile ride. And then the third thing we really think about is what are the investment vehicles that you can use if you want to invest in this asset class. And so far for the individual investor, they've been somewhat limited and they've been a little illiquid and a little expensive. And so we're looking for ways to address those concerns. And that's part of the reason that our company is as focused as we are on being part of this future.
Yeah, definitely early innings still. I wanted to switch gears to, one of the big news stories of the last couple of weeks for markets and especially for the wealthy, taxes. Jason, what have your conversations been like with your clients, about the Biden proposals on taxes and what are you telling them to do right now?
Well, you hit on a hot topic, and I get an opportunity to meet with clients virtually almost every day. And if you just look back a year and you ask clients, what are you thinking about? What are you worried about? What's important to you? COVID was number one. COVID was number two. COVID was number three. And now when we look at our clients, we just did a survey this last quarter, COVID drops all the way down to number 10. So clearly, our clients have pivoted and moved towards the future, thinking about the reopening of the economy and how to position themselves accordingly. Now, with Biden's proposal, obviously this has to go through Congress, so there's a lot of things to anticipate there. But we want to make sure that we offer our clients the thought leadership of how to think about it. And generally, we think about it in three main perspectives. Liquidity, how much money you need to really carry out your life day to day. Longevity, investing for you and your family's future. And then legacy, what kind of imprint do you want to put on your family, the community that you live in, and the people you love. And so when it comes to a changing capital gains rate, that would hit in that longevity perspective. If it comes to a possible change in the estate tax law, that would be legacy. And so something that I know our clients are going to lean on us for now and for the weeks to come as we see this work its way through Congress.
Penny, capital gains, if we see this change, how significant do you think that is for the market? And are we going to see a lot of selling? How do you see this playing out?
Well, Jason, you said it. We're in the opening salvos of this negotiation that may take weeks and months to play out. And for all of us, the effects of a changing tax environment are going to have differing effects. I think if we look back over the arc of history, though, fundamentally, taxes have not been the primary driver for economic or market performance. Corporate tax rate or corporate earnings, economic growth, and interest rates. We've been talking a lot about interest rates, really have had much more of an effect on economic growth and on market performance. That notwithstanding, each individual is going to be faced with different types of decisions. Jason, I like the way you describe sort of bucketing those kinds of decisions. And so there will be opportunities and things that we ought to think about. We shouldn't let the tax tail wag our portfolio in terms of how we invest fundamentally. But things like bringing forward income, perhaps into 2021, perhaps going ahead and recognizing some capital gains, while capital gains tax rates might be at a lower point today than they could be in the future. Those are going to be strategies that I'm sure we'll all be talking about with our clients.
Yeah, Catherine, what are you hearing from your clients? What are their concerns and how are you advising them?
Thanks, Caroline. And I think our clients really, their concerns are sort of in three areas. The first one is if. Is this going to happen? There are very slim majorities in Congress. The president might have won the election by 7 million votes, but won the swing states by 65,000. Can you really pass legislation like this with narrow majorities? We look at polling as everybody else does. On Biden gave his first speech to Congress last week. The CNN poll said 51% of viewers were very, very positive. That's good, but that's actually a lower score than the first speech for his three predecessors. And so there are very slim majorities, and yet major legislation can happen with slim majorities, including tax legislation. And so our sense is that there will be tax changes. They'll probably be pared back from some of the proposals. So then the next question they say is, but when? When is it going to happen? When will it be effective? And in particular, will it be retroactive? And we say, well, tax rates can be retroactive. We've seen that before. We saw it in 1993 with tax changes, but typically they're not. And I would say it's probably more likely to not be retroactive this year as we're trying to, nurse the economy back, through the COVID crisis. So it's probably more likely to be effective on the date a bill is introduced in Congress, which hasn't happened yet, or maybe even a later date than that. And then they say, well, what do we do about it, right? What do we do about it? And I think Penny, had some great ideas there, right? Accelerating some income potentially to this year. There are certain strategies that you should probably use if you can, no matter what. The large estate tax exemption that we have right now, the $11.7 million, that's set to expire in 2025 anyway. Everybody's portfolios are at, tipping at highs. And so they do have unrealized gains, and thinking about how to, structure your portfolios and maybe diversify. The 5 largest tech stocks have become a very large segment of the market, 25% or so of the S&P. So maybe take that idea to diversify. Maybe think about converting a traditional IRA, pay taxes now, and convert it to a Roth IRA. So we're talking to them about a whole range of strategies, and including some that don't really have to do with the market at all. They have to do with interest rates and locking in the very, very low interest rates that we have right now.
Got it. Sticking with the COVID crisis, Penny, could you describe to us how has this last year, more broadly affected your clients? And in particular, a lot of people talk about this period of having hit women particularly hard.
Mm-hmm. It has indeed. I mean, obviously the economy has been hit very hard. Folks' confidence has been hit very hard vis-a-vis their employment. What they're doing to help their families. We found in a study that we did the middle of last year during COVID of folks who were preparing for retirement and in retirement, what were they concerned about? And Jason, you brought this up just a few minutes ago. We found that they were concerned about their health. They were concerned about family, their own purpose, and their finances. And so as we talk about how that affected different investors, and Caroline, you mentioned women, there's some really challenging data out there about it. So, for example, women lost 5.4 million jobs during the pandemic. Men lost 4.4 million jobs. In fact, women accounted for 54% of the job loss last year during the pandemic. And one of the things that's always been true historically is that there's been a differential in confidence among women investors and men investors. Last year, we saw that male investors were 54% confident about their financial future and their retirement planning. Women were at a 41% confidence level. Historically, we've generally been about 10 percentage points apart between men and women, men with a higher level of confidence than women. That was exacerbated last year for many reasons, in large part because job loss affected more women. I hate talking about those sort of dire statistics without offering something up, though, something positive. The positive in that, I believe, is that investors, women investors, men investors alike, are thinking really carefully about their own financial resilience. They're thinking about what could happen to my family, what might happen to my family if something unexpected happens, and how do I prepare for that during better times? We're seeing more clients thinking more carefully about protection, about their emergency reserves. They're also thinking more carefully about what's most important to them and planning for that. And that's what a good financial advisor does. That's what we talk with our clients about all the time. What's most important to them: their health, their family, their purpose, and their finances. And so during a time when so many of us have re-examined those things, we are really having that conversation anew with our clients, male and female, no matter what age or stage they are in their lives, about planning for their future to create more possibilities for them and their families. And we've just had a life-changing lesson in what it means to be prepared for times that are less sanguine than we would desire. And now, coming out of this, renewing our focus on the future for men and women investors, I think we're in a tremendous place to help more people create more of those possibilities.
Definitely some
Penny,
dire statistics there.
Penny and Caroline, if I could, I would add one thing to that.
Yes,
I think
go
you're
ahead.
exactly right, Penny, about the confidence gap. But the other thing that we know is it's not a competence gap when it comes to women as investors, because what the data shows is women are very good at setting long-term goals, which is the single most important thing for an investor. And they also tend to be good at managing risks and staying the course. And so there may be a confidence gap, but there's not a competence gap, which is really, really important.
Right on, Catherine.
Yeah. Like to hear that. Jason, could you speak about, how has COVID changed UBS's financial outreach and your view on the world?
Well, I want to pick up on a couple of things that Penny and both Catherine said in terms of how this pandemic has, impacted different parts of the population, specifically women. We're proud we do a significant amount of research, in this area. We call it Own Your Worth, and we just had our last installment a couple of weeks ago, led by Paula Polito. But I think, Penny talked about this, key relationship between a financial advisor and a client, and we see it in a very similar way. This past year, that relationship became even more important. It became more deep. Clients opened up about their family, their health, their purpose. And so we ultimately believe this business starts with people and ends with people. It's part of our purpose statement, connecting people for a better world. And so our view of the business really hasn't changed. I think it's actually been cemented that the wealth management business is very people driven. It relies on trust and real relationships. But we couple that in this last year, working from home and working remotely, that clients are very comfortable with all different types of digital ways of interacting, depositing a check through their phone, reviewing their performance report, updating their account information, applying for a mortgage. And so we see this powerful combination going forward, where it's really the power of that personal relationship and financial advice, coupled with the convenience of the ease of technology. And we see that trend only accelerating in the future.
This is a relationship business you all are in, and historically it's been, one that has had a lot of in-person, contact. Catherine, the business had already been going through changes with technology between robo-advisors and now, of course, the rise of Robinhood and so on. Have people gotten used to not meeting in person, and do you see this being a kind of a permanent shift for your business?
So I think this environment has really done two things for us. As Jason said, it's changed the business model a bit. Historically, it was obviously in person with some digital interaction as well. I think what we're doing right now, virtual, is a new part of the business model, right? And I think that will remain. And in fact, it will be interesting, Caroline, to see how you do this conference next year, and whether it's all in person or if it's in person and virtual too, because I think there are a lot of benefits to both. So I think that third leg of the business model being virtual will remain. I think the more important thing, though, you say, Robinhood and the retail investor, I think the more important thing there is how important the market is to the retail investor, not how important the retail investor is to the market. And what I mean by that, if I think about Jason, Penny, and me, and if we think about when we started our careers, maybe 20 or more years ago, the typical client in a wealth management business might have been a retiring executive, someone that had had a career in corporate America, retired with a pension plan, and whatever savings they'd also accumulated personally. Well, today, with the change in retirement savings in this country, really not centering around corporate pension plans that are going to pay you an annuity for the rest of your life, instead centering around your personal savings, 401ks, IRAs, other savings. What that means is that the market is very, very important to the retail investor because they need to become, working with their advisor, their own CFO, their own chief investment officer, and they need to embed those institutional disciplines into what they do. And the single most important investment discipline that they need to implement is behaving like an institution, right? Institutional investors have an investment policy statement. They know what their goal is, and then they stick to it through cycles. And so what that means is when the market goes down, as it did last year, what you tend to see is the institutional investor will rebalance. Oh, my equity allocation got below my desired level. I'm going to rebalance. I'm going to buy equity. There's nothing that makes any individual do that, but it tends to be the right thing to do. And what we saw happen last year was it isn't really what many retail investors did, right? We watch fund flows. We see where our assets going in mutual funds and ETFs. And last year, most of those assets did not go to equities. They went to fixed income and to cash. And so what that means is some investors might have missed, some of the dramatic early run up in the market. Now it's coming back this year. We're seeing flows back into equities. But really, our job is to try to help our clients implement those institutional disciplines so that their performance is as strong as their college endowment or any pension plan.
Yeah, I mean, it's interesting. And Penny, I mean, as you think about these changing dynamics, I mean, how much of the solution for your clients is sort of human-based and how much is technology-based, and how has that balance shifted?
Mm-hmm. Well, I think all three of us are focusing on the fact that helping families with emotional decisions around the balance of complex financial needs is best done by a human being who brings the empathy, what we call the EQ, and the knowledge of wealth management and products and services to bear. The IQ, the proper balance of EQ and IQ, is a very human-centered thing. It's rooted in the trust and confidence of the relationship between the client and the financial advisor and the team. We think that is becoming ever more important. That does not say that technology isn't part of the equation, but we believe strongly, and I think your other panelists, my guests here as well, believe that there is such a thing as human-centered technology, technology that can help enhance the experience, that can make it more dynamic, that can make some of the administrative things easier, that can make sometimes portfolio building more consistent and effective, and as Catherine was focusing on, taking the emotion out of that portfolio building. But fundamentally, a family focused on their future is a very emotional thing, and it's quite complex. And so we believe that the necessity for wealth management advice for a family and their future generations, for whatever they think is most important, is a human-centered business. And I will take this opportunity to say that it has always been an important factor in our economy, helping families be more resilient. There's a natural generational transfer going on in our industry right now, and this is a marvelous industry to be a part of, for emerging investors to be a part of, as well as for new financial advisors who are really seeking to put their own life purpose, their professional purpose, together with making a difference for other people, together with a tremendously important profession in our economy and in America. So I invite them all in.
Thank you. We're running out of time here, unfortunately, but before we wrap up, I did want to just do a quick lightning round and get everyone's best idea which part of the market do you think is the most attractive right now? Just to help our audience here. Jason, let's start with you.
It's clearly sustainable investing. In our last client poll, 50% of our clients are interested and see this as an opportunity in the future. So we've pivoted our firm to be much more responsive to sustainable investing.
Catherine?
So I would say the reopening trades, right? So, small cap versus large cap, international versus domestic, value versus growth, tilting to some of those areas is very important. And it's hard to do because, the last decade you did really well. If you just bought the S&P 500 and the Barclays Aggregate Bond Index at a 60/40, you did 10%, just like that. So it's hard to do, but we think it's the right thing to do. More small cap, more international, more value in your portfolio.
Thank you. Penny?
If you haven't rebalanced your portfolio in the last 6 months, the best investment is whatever you've gotten underweighted on, given your tolerance for risk and the longevity of your objective.